What if I told you your dream of owning a home or buying that next investment property right now is slipping away from you? And that the people who said they were going to fix the problem are actually making it worse right now? When they're attacking Jerome Powell, they're attacking the full faith and credit of the United States, and that's hurting you and your money. In this video, we're going to talk about how I believe these attacks on Jerome Powell are actually hurting us, not just in the short term, but possibly in the long term, how it can cause rates to rise if we keep up these actions, and how it's going to affect your money and real estate, that thing that we love. President Trump acts like he did not nominate Jerome Powell for his current position. He calls him a knucklehead. He's making claims that the current Fed's fund rate should be as low as 1%. That would light the freaking economy on fire and possibly reignite inflation. He's calling for Powell to resign. He's talking to Congress about does he have the power to fire him? But is this hurting us more today and in the future? And he's not the only one. So in this video, by the end, I want you to understand what these attacks mean, how it's hurting our monetary system, how it's hurting the full faith credit possibly of the United States, and why I think we shouldn't be doing them, but we do have to apply some pressure. I just think we're doing it the wrong way. So the Federal Reserve isn't just a boring bank. They are a bureaucratic body that sits independent. Now, that's what politicians, and it doesn't matter if you're Republican or Democrat, that's what they don't like. They don't like that they don't have full control over the Federal Reserve. But I want you to understand that is the economic engine. This is one of those things that powers our capital machine. Their job is to keep the ship moving in the right direction and keep it steady. And that means balancing full employment with long-term stable prices. And to do this, what they do is they set short-term interest rates, the rate at which a bank borrows from them overnight. And these are all like boats in the harbor. And as they set that short-term rate, it then causes the other rates further down the curve to then change or move towards it. But as you can see, when the bond market doesn't agree, the 10-year treasury will move in the opposite direction of rate cuts. So the bond market and the rest of the world has to be in agreement with what we're doing from a fiscal and monetary policy in order for our rates to actually drop. I need you to understand the 10-year treasury is what sets the rate for all debt here in the United States. That's what causes your mortgage rate to go up or down, your auto debt, your student loan debt, your credit card debt, also business debt, the rate at which they borrow, their lines of credit, all of that will move up and down with the 10-year treasury. And the market has already said that they don't have to agree with the Fed. So even if we had the rate cuts today, there's no guarantee that the 10-year treasury would come down unless the overall market, and that's not just politicians, that's not just the United States, this is the freaking globe. If the whole globe believes that, one, we have our house in order, two, we are finally getting our debt in order. In other words, we're being fiscally responsive, but the big, beautiful bill just came out. So we just added trillions of more dollars in debt. And they believe the US is being stable and moving in the right direction. Long term, those rates will naturally come down, but they're not coming down fast enough. I want them down now. I like cheap debt, it helps my industry, but I don't like undermining the US brand, let's call it, and the confidence of the United States and our capital system. If the rest of the world can't trust us, they won't bring their money here. If they don't bring their money here, our debt doesn't go down. If the Feds cave to politics, the rest of the world can look around and go, the game is rigged. And then what happens is your dollar does not stretch as far. That salary that you're getting doesn't stretch as far because your credit is more expensive. And we are a consumer-based economy here in the United States that survives on credit. Let's talk about who the critics are and what their claims are against Jerome Powell, the chairman of the Federal Reserve. I think one thing that they're also doing too is they got to remember that Jerome Powell is literally one 12th of the Federal Reserve Board. You still got to get 11 other members to agree with you to even be able to drop the rates. And when you look at the Fed Beige Book, when you look at the Fed Beige Book, yeah. When you look at the Fed Beige Book and you look at what the other voting members have been saying on national television, you can tell the Federal Reserve itself is completely fractured right now. They do not all agree. President Trump has been one of the most vocal critics about Jerome Powell, the chairman of the Federal Reserve. But Trump elected him or nominated him to that position. And his term is up in May of 2026. And they're talking about bringing on the next replacement sooner versus later. In other words, announcing them, creating a shadow Fed president so that they can undermine Powell when he's not moving in the exact direction that they write, or when he's not moving in the exact direction that they want. President Trump has claimed that Powell is the only one standing in the way of lower rates, that today rates should be more than 1%, and that 1% rates could save the United States on our debt over $1 trillion. So we just need to get the rates down now. And then beyond his claims, he's just plain using name calling. He has literally called the guy, and I'm reading from my list here, numbskull, moron, terrible, one of my worst appointments, and a knucklehead. I don't think that helps the brand United States. See, one of the things that happens with investors is capital flows to where people are comfortable. If people are fighting and arguing on national television, it slows down capital flow. And these threats have escalated into President Trump talking to Congress about, hey, can he fire him? And demanding his resignation. Then all of a sudden, the Federal Reserve headquarters is costing $2.5 billion, possibly $2.7 billion in their renovation plan. And so now that's causing this whole huge kerfuffle right now because it's extravagant, it's disgraceful, it might be a fraud, it's gross mismanagement. I'll tell you, this is not helping the situation. Another one of the major vocal critics is William Pulte. That is the heir to Pulte Homes. He's currently the director of the Federal Housing Finance Agency. That's who controls FHA, VA, Fannie Mae, Freddie Mac. He's the one who gets to impact housing in a major way. And because he's supposed to be our housing market advocate, what worries me is when he's asserting that the Fed's policies are totally reckless, greatly unjust to the housing sector. He is one of the people who is creating that instability. And all you have to do is go look at the 10-year Treasury. The 10-year Treasury, every time we have a major attack by one of these people, you can see it start to float up. Now, I realize there's other things that are in there too, the PPI, the CPI, unemployment. But this negative talk in the background is hurting us in rates. We all know part of the reason the housing market here in the United States is not turning over quickly because of the lock-in effect. And that's where people who own a home have a 3%, a 2%, a 4% mortgage. And today, of course, they're around 7%. And these high rates are preventing people from turning over. So what Pulte's been doing in pushing on this is he's trying to get rates lower to help alleviate that lock-in effect and to unlock the U.S. housing market. As soon as rates come lower, the U.S. housing market will unlock. I'm totally ready for that. Right now, we're below 4 million transactions. And below 4 million transactions, we're selling about the same amount of homes we did in 1995. As rates come lower, transactions will pick up. But we must go about this in a manner that doesn't hurt the U.S. long term. And you've got other critics that are just as vocal, but not quite as powerful or as well known as these other ones. You've got Russell Vought, his accusations of gross mismanagement by Jerome Powell there at the Fed. You've got Anna Pauline Luna, and Anna Pauline Luna is one of those very vocal MAGA supporters. She's kind of behind everything and just says yes, yes, yes. But she goes through and talks about the imminent dismissal of Jerome Powell is calling for the DOJ to investigate Jerome Powell because of how much money is being spent on the remodel of the Federal Reserve building. Yes, it sounds egregious and way more than even like $500 or $1,000 a square foot, but I don't know if this is criminal. As I voice some of these opinions, some of these are going to be right, some of these are going to be wrong, because we don't know exactly what's going on in this situation, and we're looking through what the media is saying. I want you to drop into the comments your thoughts on what's happening or what we're missing here in this dialogue, and whether you think Jerome Powell should be fired right now and we should have rates go down if it's worth the long-term risk. So why does any of this matter? It all boils down to one word: independence. And it's more critical than you think in relation to your everyday life. Because, like we said, the Fed's job is stable pricing and unemployment. And when they have that dual mandate under control and inflation under control, and let's not mince words here, they were wrong when they said that inflation is transitory. They waited too late, and they're probably going to wait a little bit too late to cut the rates again. But politicians want control, and they want lower interest rates because this could save us billions or trillions of dollars. But this is really a short-term mindset. Giving control more to the politicians may work in your party's favor today or against your party today. But I guarantee you, if this happens, you're going to be pissed off from a political reason here in just the future, because the other party will just do it too. So we need to keep the Fed independent. This is one of the best monetary systems. It's not perfect, but one of the best monetary systems that has allowed our country to massively prosper over a long period of time. We need to do everything humanly possible to support that. And I want you to understand, there is a myth that the Federal Reserve is in direct control of interest rates. I'm here to debunk that. That is completely untrue. They do not control all interest rates. The only interest rate that they control is the one we mentioned earlier. It is the short end of the curve. It is the overnight rate. Now, as the overnight rate changes, it generally makes it easier for banks to move money around to create liquidity overnight. And generally speaking, longer term rates follow, but longer term rates will only follow if the rest of the world who buys our debt believes and feels secure. So let's stop making them insecure. And there are other economists like Peter Schiff, who is the chief economist and global strategist at Euro Pacific Asset Management. He's contending that rates are still too low. And he says the evidence shows up in extensive consumer and government borrowing, low savings rates, and just look at the price of gold and how interest rates remain excessively low. Also, I mean, look at Bitcoin. It's just been ripping. So there's a counter argument to this other argument that rates are actually still too low. Everyone else is going to counter this argument and say, but the rest of the world has already started cutting rates. That's because their economies have massively slowed down. Ours is in the process of slowing, but it hasn't slowed down to the point where it's dying. So conversely, when rates do come down, what do you believe is going to happen? I believe our economy is going to straight rip. And we could go through a 5 to a 10-year golden run, a golden boom in real estate and in assets. We're going to go through the great asset melt up number 2, like we kind of talked about before in one of those previous episodes. There's so much cash inside the system from the money printing. Go look at the money markets, the CDs. As rates come down, that liquidity is going to go into the market and all asset prices will rise. I just want the US economy to be stable long term. I want good, cheap debt long term. And I'm willing to sacrifice a little bit today in order to get good, cheap, long term debt. But I understand why they're screaming for lower rates, because lower rates have absolutely crushed affordability in real estate. We are at the second worst time of affordability since the 1980s, when Paul Volcker had to take rates to almost 18%. And then how dramatically does this actually affect prices? If you have a $300,000 property at a 3% rate, the monthly payment is $1,265 a month. That requires about 62,000 in income. That same 300 grand at a 5% rate, all of a sudden it jumps to 1610 and requires about 77,000 in income. That same 300,000 at 7% jumps to almost $2,000 a month and now requires 93,000. So when rates jump from 3 to 7%, you've seen the required amount of annual income literally explode. Now let's look at it 500, because here in the Seattle metro, our average price in Snohomish County is like 850,000, and in King County it's like 1.1. At 500 at 3%, your payment is 2,100 and you need 100 grand to qualify. 500 at 5% is almost 2,700 a month and you need 128,000. 500 at 7% is $3,327 a month and you need 156,000. So as you can see, when you're buying a home with minimum down, the rate dramatically affects the monthly payment. This is what everyone is up in arms about, is rates matter. And until interest rates get into the low sixes, the real estate market will feel stagnant. For my investors out there, for my first-time home buyers, that is your opportunity. Go make more offers right now. Spiraling consumer debt is absolutely crushing the average consumer. And so this higher national debt leads to a loss of confidence, which leads to higher treasury yields, which then leads to the government having higher interest expense. But the problem is that same thing is happening on the consumer side. So the average individual is having to pay more for their credit cards, more for their auto debt, more for their housing. And what this is doing is it's leading consumers to spend less. We're heading into a time where the economy is starting to show signs of slowing down because the consumer can no longer spend as much. And this is why they will have to cut rates before the economy collapses, or they'll push it a little bit too far, and the cuts are coming. The other side of this equation is people believe that inflation is not all the way under control. They believe that the tariffs have not quite shown up yet. So they're just trying to be cautious before the rate cuts happen. But right now, there are still 2 rate cuts priced into this year. What we don't want is we don't want to see inflation go unchecked and de-anchoring of inflation expectations. And then we're in a point of stagflation where the economy is not growing and inflation rears its ugly head. Now, I personally believe we already beat the inflation boogeyman. I believe rate cuts are coming, but I don't believe attacking the Federal Reserve and Jerome Powell is that solution. So what's the bottom line here? This isn't just political grandstanding. This is about protecting the bedrock of the U.S. financial system and how we are the most desirable capital market in the globe. And this is something we really need to pay attention to, protecting that. Because the reason that all of us have enjoyed prosperity, the reason our economy grows is because so much capital and talent flows here. The U.S. brand has to be, this is the place where you can come, grow a business, make it happen, and the streets are paved with gold, and we're the land of opportunity. We have to be the place where politicians can't interfere with money printing and the inflation. Otherwise, we could turn into an Argentina where things just get completely out of control. This is a dangerous paradox that we are pushing on by attempting to force rates lower when they are actually higher because the globe believes they should be. They will naturally come down once tariffs are under control, and that is negotiated. The big beautiful bill is behind us, so that's looking good. Inflation is also looking good. CPI, PPI, and PCE all looking good. Not perfect, but they're all looking better. This is simply a function of time. I personally believe we need to back off of the attacks against Jerome Powell and the Federal Reserve. I believe our financial future depends on it. We need to have empowering messages from our politicians that provide faith in the United States. And as that faith in the United States is restored, more capital flows to what is comfortable and what is known. This is creating risk today. The market wants to see less risk, and I believe rates are heading down anyway. So I think that we should just kill off the rhetoric. Let the rates naturally come down. We know that Powell's getting replaced in May 2026 anyway, and that some rate cuts are still on the table. So relax a little bit, people. It's coming. I just realized we're all impatient in this internet era. And for you on the real estate side, I always want to leave you with a couple actions. One, this market uncertainty is going to continue. So this means it's great for buyers and great for investors. Two, if you're a seller, you need to ask yourself if you are also a buyer. Right now may not be the right time to sell, but next spring might be better. It's going to depend upon your situation and where you're at, where your property is positioned in the market, and what you plan to do with the money. We're happy to have all of these discussions with you about what you should be doing with your money, where the market sits, and how this political grandstanding, this chest beating, this attacking of Powell, I believe is not helping, but it is creating opportunity on the investor side. I'm Anton Stetner. Hit that magic subscribe button. Share this with a friend that needs to hear it. And thank you for hanging out with us again today.